Investment Management. Thanks for joining us today.
Great to be here.
Is this completely an AI-driven market?
Well, it's certainly a theme that's not dying, and we're big believers in the thesis around AI. Now, admittedly, the markets have moved a long ways on this idea, and valuations are a bit stretched, but we are believers in the AI theme, and we think there's a lot of capital X that's going to be spent over the next many years. And names like Oracle in the last 24 hours highlights the potential power there and the earnings benefits that some of these companies will have. And so it is real. It does not seem to be dead. And there's a lot of players that are still pushing in the direction of how to incorporate AI, both from an investment perspective, but also from a business planning perspective.
Are there risks? And if so, how are you working to minimize them?
Well, the risks are a couple-fold in our view. First of all, people know that AI is a theme. This isn't new. And so there is a lot of names that are very pricey at this stage when it comes to a valuation perspective. So I would be a little bit cautious about entry points on some of the names, particularly at the lofty levels that they're trading at. The second thing is there is competition here. There is going to be winners and losers, and not everyone can win. And I think that's an important thing to think about, that there are players that will get some benefits in the short term, but may ultimately not be the biggest winners in this space. And then the other thing is, who's the real beneficiary here? The beneficiaries are going to be obviously the names that are selling into this and actually developing the technology. But just as importantly, where I don't think we've seen the market completely appreciate, is there's going to be a lot of names that will benefit from the technology from a cost savings perspective and from an implementation perspective that may still be underestimated by them. And I'll use the example of software names, where a lot of software names haven't done very well. But there's some real benefits to software companies as well because of AI. In the short term, the negative is that, AI is going to take over for them. But the reality is it does lower their cost structures in many cases as well. So there's a mixed bag here. Our general view is this thesis is real, but not everyone can win. We need to be careful about where valuations are on some of these names.
Okay, let's talk about where else you have been rotating money into financial and healthcare. Healthcare, of course, has been pretty beaten down at the start of the year. So why are you putting money into healthcare, and financial is just sort of more defensive for you?
Well, financials we've liked for a while, and it's worked pretty well. Financials have done well for pretty much the last couple of years at this stage. We think the balance sheets of financials are in a pretty good spot. We think the economy is holding up well enough to support financials. We think regulation in certain geographies like the United States, where I'm based, is a benefit for financials. And we think there's M&A opportunities still. I would also argue on the Canadian side, the Canadian marketplace has some of the highest quality banks in the world. Now, admittedly, they are trading at pretty nice premiums given the recent rally we've seen in some of those names, where many of the names are trading well over 2 times book at this stage. But keep in mind, these are some of the highest quality banks in the world in our view, and they are probably deserving of that higher multiple in many cases. So we like financials just because they are strong quality balance sheets, and the economy is holding up well enough for these names to continue to participate from an economic perspective. On the healthcare side, it's a different story. These names are beaten up. They are very unloved globally. There is a lot of pricing pressure. There's regulation concerns. There's competition concerns. And there's a lot of drugs that don't ultimately see the light of day. And there's a lot of dollars that go into that research and development. But the market has really punished some of these names. And some of it's been driven by regulatory concerns, Medicare payments, et cetera, particularly for some of the US names. But valuations have priced a lot of that in our view. And we're thinking we're getting past some of the sentiment and the negative views around some of these regulatory challenges, where we're starting to think there's some opportunities here to nibble in some of these names, redeploy some of the winners that we've had on the technology side from a dollar perspective, and rotate that into some of the healthcare and financial names that we talked about earlier.
What about abroad, markets that you're looking at outside of North America?
I think that's been the biggest surprise of the year. I'm based in the U.S., as I mentioned, and we've seen most economies around the globe have better stock markets year to date than the U.S. And that's not just because of the weaker dollar. And on an absolute level currency basis, we're seeing most of the other countries outside of the U.S. outperform the United States. On top of that, if you're a U.S. investor, you've gotten the benefit by being outside the U.S. because the dollar has appreciated. We do like certain markets outside the U.S. Japan is a notable one for us, where we think there continues to be a relative improvement when it comes to profit margins, shareholder friendliness, governance policies there. They're beneficiaries of global supply chain dynamics that are shifting around the globe, and they have a very educated population and a hardworking population. And their ROEs, while they'll never be as good as probably some of the highest quality U.S. companies, they're improving. I think that's the important thesis here, that the margins for some of these Japanese companies continue to improve. So we like Japan. And we're increasingly warming up to parts of the broader Asia market as well. China's been a surprise this year. It's outperformed a lot more than we would have thought. But I think there's some real reasons for that. We're seeing a sentiment shift. We're seeing domestic buyers come back into the market. We're seeing policy dynamics that are stimulative, particularly for parts of the economy, such as manufacturing and infrastructure. So we're warming to other parts of Asia, but notably right now, we're overweight Japan, we like Taiwan still, and we're also overweight South Korea.
Nate Thooft, I've got to leave it there, sir. Thanks for joining us. Nate, CIO, Senior Portfolio Manager, Manulife Investment Management.